All right. So thank you everyone for coming to this real estate event through the MIT Club of Northern California. Um, I will start now. The This event is being recorded, and the recording will be made available to everyone later on, so that you can view this again, or you can pass this to your friends if they're interested. Today, I have the honor of having Michael Feldman, uh, my class of '89 classmate, on the call, and also Evan Mateo, um, who's also been on the board of directors with the MIT Club with me for seems like 10 or 20 years now. And then we also have Jason Escamilla, who is running the MIT CNC FinTrack. He's going to be the administrator on the call today. So we'll go through a very quick round of introductions, and then we'll dive straight into the prepared questions with my panel, and then at the end we'll have time for Q&A. So, uh, Michael, why don't you introduce yourself first?
Sure. Hi, Michael Feldman here. Great to see all these people on the Zoom. As Ron mentioned, I'm class of '89 from MIT, and I've spent the better part of the last 35 years here in Silicon Valley. And I was a software engineer at the beginning of my career and have been entrepreneurial and started companies, and I shifted to real estate. I actually bought my first piece of property um, uh, about over 25 years ago, and started doing rentals and expanding into other types of real estate. And I made the leap to from tech to completely doing real estate about 8 or 9 years ago when my last company was acquired.
Awesome. Thank you so much, Michael. Evan,
Hi, I'm Evan Mateo, class of 1994. Been in the Bay Area since '97. Started off in enterprise software and made the switch about 2003 uh, to real estate. I've been a real estate broker and owner of a brokerage firm since 2006, 20 years. Um, I also, together with my wife, have acquired a small portfolio of rental properties. Uh, I live in a 4 unit building with my family, uh, in about half the building. And in addition to the brokerage um, and uh, rental property ownership, I'm in the process of constructing 5 ADUs inside of a 7 unit building here in San Francisco. And I work with the San Francisco Association of Realtors on several board committees, including the Government Relations Committee. Um, we are in a very heavily regulated environment here in San Francisco. And once you own enough property, uh, getting involved in the regulation and trying to improve it through work with the electeds is a useful way to spend time.
okay, thank you so much, Evan. And then quickly for my bio, I moved to the Bay Area in 1990 to start my tech career in the semiconductor industry, where I worked for nearly 30 years. Um, I got married in 2007, and then the first project that my wife and I did was to build our house in Los Altos, and we managed to survive that. Um, Later on in 2012 and 2013, um, I bought apartment buildings in San Francisco, and then after that, I became limited partners in various real estate funds around the country. And I will add that the reason that I invested in the San Francisco apartment building system, my wife and I would like to be able to retire in the Bay Area. And so my reasoning was that at least the rental income from the San Francisco buildings should roughly track the cost of living in the area with some delay. So that was a primary motivation for me. Um, all right. So Jason, would you like to introduce yourself quickly?
Yeah, hi. Thanks, Ron. My name is Jason Escamilla, MBA 02 from MIT, and been in the Bay Area basically my whole professional career, other than 2 years in MIT. Work in finance my whole career, in wealth management. Today, run a wealth management firm, locally based wealth management firm. And with the fin track itself, or finance and fintech track, basically, this is an opportunity for, and I'm going to just do a quick share of the screen here for, this is the opportunity if you guys get more involved. So we have a track page, mitcnc.org/page/finance. You can also get information about today's speakers, past speakers, upcoming events. We have an event later in March on tax-aware investing or concentrated stock risk. It's part 3 in a series. I'm really excited about that one. And on Friday at noon, we have a Zoom for like informational or volunteer sessions for folks. I'm going to hear about people that want to get involved. They don't know how, whether it's finance track or really other tracks. I mean, you can come pop in, meet and see if there's some overlapping interest in the type of events we do. The more volunteers we have, the more we can do. So with that, I'll turn it back over to Ron. I'll be watching the chat, try to keep an eye out for questions, but I'm just going to be working in the background here. So I'm just going to go and mute, and we'll let you guys take it from here. Thanks.
Yeah, so I
Thanks, Ron.
encourage everyone to use the chat feature during this event. And then please ask your questions. Jason will collate the questions at the end and ask them to the panel. With that, let's get going. So to my panelists, Michael and Evan, let's ask the burning question. Why do you invest in real estate? Aren't there other choices out there for investments?
Michael, you want to take a stab at this, or would you like me to?
Sure, I'll jump in first. So, yeah, you're right. There are other investments, and I am diversified. Having spent a lot of time at Google and other tech companies, I still hold a variety of different assets, but real estate just gave me a lot of control over my financial destiny, and as an entrepreneur, a lot more flexibility. And then, of course, it's there are a lot of tax advantages as well to real estate. And the skills that I used in the tech world, analyzing deals and partnering with people, interacting with people, thinking creatively, translated really well into real estate. So there's still an intellectual challenge, but the opportunity to create real tangible assets, not just digital ones.
Awesome. Thank you, Michael. What's your take on that question, Evan?
Yeah, I appreciate everything that Michael's referenced. For me, real estate is something tangible. If you go back to the founding of our country, or even before America was colonized, laws around real property ownership have been codified, respected, and real estate has been a way to build generational wealth. So for me, coming out of tech, I saw real estate as a way to use the analysis skills that I had gained working for software companies, have a purchase size which was large enough to be meaningful, could be leveraged. So it's one of the only assets where it's relatively safe to use large amounts of leverage. Sure, you can buy stocks on margin, but good luck if the market swings against you. In real estate, no lender can call a loan on your house as long as you're making your payments, and you can buy it with as little as 20% down. You can also then pull equity out as the property appreciates and buy your next property. It's a really fascinating vehicle when used with other investments as part of an investment portfolio. So, I do not advise putting 100% of everything into real estate, but most people here have a 401k, have some equity in whatever tech company they're in. Supplementing that with real estate not only provides diversity, but also puts you into a leverageable asset, which tends to go up. Personally, I like the ability in a rent controlled environment to, unlock some value. But we can talk about that more later. Generally, real estate, has tax advantages, has leverage advantages, and is something which tends to appreciate over time.
Awesome. Thank you, guys. Let's move on to the next question. How is the current situation in real estate right now?
I'll take a lead off on that. So my focus in real estate is geographically centered in California and predominantly in the San Francisco Bay Area. So I'll speak to that. Um, Michael, I know has a broader national perspective. Um, within the U.S., within California and San Francisco in particular, we have multifamily investments. You've also got uh, office and other commercial retail. Um, eh, Office and retail have been in the news as having declined in value dramatically. Um, the same is also to some degree true of uh, multifamily, although it's been less dramatic. I would say that now represents a generational opportunity for acquiring assets at a relatively low price. Um, Rents peaked last in 2017 in San Francisco, and they're now back on their way up, having gone down quite a lot during COVID. Um, Property values track with rents. Um, if you are interested in office, that sector has taken a haircut. On the larger side of properties, um, the values move faster because it's institutional money. So, in multifamily, you've seen large portfolios of properties that are now on their second or third owner at reset values. That's also true in office, where you've seen properties trade in some cases at, 25% of the value from their peak. Um, so it's a good time if you believe in the area and in the sector that you're buying. Prices are better than they have been in a very long time.
Okay, Michael, your take.
Yeah, sure. And just to echo what Jason said and I'm sorry, what Evan said and broaden that out. It is, you can't just answer that with the market is good or bad. It depends on the asset class and the geography, as he was saying. And office in San Francisco is much more depressed than it is, say, in a place like Miami. So um, if you take a step back and you look at the trends with real estate, it really is about supply and demand and the growing population. And um, over the past decade, prices have grown a lot, especially when interest rates were low. The higher rates have definitely caused transactions to slow and created headwinds, but there are also a lot of opportunities because a lot of owners, um, some owners could actually be locked into lower rates and can't move, whereas other owners might have floating rates and their costs have exceeded their income. And so there's good opportunities to purchase those more distressed assets. But the long-term fundamentals are strong. I've been through multiple cycles, and I've seen a lot of fear selling in times when the credit markets are locked up and you have to pay cash. So there's still a lot of opportunity. Obviously, inflation has an effect. And then looking nationally, when I look at opportunities to evaluate whether it's by asset class or actual property, looking at the macro trends like demographic shifts and population shifts. So, for example, right now I'm actually looking at apartment buildings in Dallas just because of the movement in population and the long-term growth expected. So there, the market in the is really, it's always in flux and in a cycle. And in some places there are generational opportunities, and others there may be, as long as you are patient, they're over the long term. It's always prove that if you're if you're savvy and analytical, that you can mitigate your risk.
Wonderful. Let's dive into a somewhat hairier topic, tax advantages in real estate. And I know that we could spend hours just on that, but try to give the best flavor you can to our audience.
Sure. Yeah, I can start. I mean, one of them is just the way that real estate is taxed as profit after depreciation. So taking deductions for depreciation, especially on income producing properties like rental properties, is a great way to keep taxes down. And you're in control of when you are being taxed on the gains, because you can determine when to sell the properties. So and then in terms of estate planning, as people age, that's something important to think about. And there's when you're passing on property to your heirs, there's a cost basis step up. So you're avoiding a lot of the estate taxes, obviously being able to deduct mortgage interest. And then there are more complex things like 1031 exchanges that basically let you roll your profit from an existing investment and defer the taxes on that. And I'm sure there's more as well.
Yeah, just to add to Michael's comment, you do get to take depreciation against your passive income every year. That's a non-cash expense, but it offsets your income. The step up in value at death is awesome. In addition to those items, Michael, you mentioned a 1031 exchange, but to just explain that a little bit, when you sell an appreciated real estate asset, if you own it in your own name as opposed to through a REIT, and I saw a question from Leonard Benchik in the chat, why do we do this by yourself? If you're not invested in a fund, if you own it yourself, you can defer that gain forever. So you can take your proceeds from a sale and roll them into your next property or properties. You cannot do that in a fund. And then the fourth reason why this is tax advantaged is you can deduct interest on leveraged debt and pretty much every expense of property. So your non-cash expenses of depreciation, but also your financing costs are deductible. So it ends up just being quite tax favorable. And there are some things that benefit you only if you own it yourself versus in a fund.
Okay. I also want to chip in with one very important fact that's not terribly well known or understood. When you sell real estate, it is potentially possible to unlock passive losses and take them against your W-2 income. It's a bit complicated. I'm not going to go into details, but it is possible with real estate. And that's one of the hardest things that people have ever tried to do, is try to deduct any of their W-2 income or shelter it from taxes. Okay. So along the same lines, can you invest in real estate through your IRA or 401k plans?
Okay.
Michael, let me take a stab at this. The answer is yes, with some caveats. So there's such a thing as a self-directed IRA, but generally purchases of real estate from a retirement vehicle have to be cash. And there are corner cases where you might be able to get finance, but you can do it. You lose the leverage ability, but there are ways of making that work. So, for example, I have a friend who wanted to invest her IRA in real estate, and went to a peripheral market to San Francisco and bought condos. Um, so, for 80,000, $100,000 a pop, she could buy several condominiums, or ended up buying a 4-unit building in Sacramento after a while, and use the appreciation of those to then go and buy new things. So it is possible. Be aware of the rules and don't expect to use leverage.
Okay. Words of
Yeah.
wisdom, Michael?
Yeah, just building on what Evan said as well, and just kind of expanding out to his comments earlier about the REITs. There are different ways to invest. I guess I would say passively as well as actively. And I know Ron and I have done a lot of this, where we're not just the ones that are putting together the deals or sponsoring deals, but investing with others that and there's a lot of good reasons to do this. I mean, one is just diversification, so that I'm mostly focused on residential properties, but there are great opportunities in many other asset classes like mobile home parks or industrial warehouses or data centers, cold storage, office buildings, hotels, etc. And so finding managers that are syndicating deals, and people that you trust, and to manage the money and help you diversify. And then even REITs are obviously in the public markets, and it doesn't require a lot of capital to get into those. So there's ways to get in, whether you're the one that's actually doing the deal, or letting someone who's an expert do the deal and investing alongside them.
Thank you. So I have gotten a question from another alum already. They were wondering, what's the smallest amount of money that you can invest in real estate to get your feet in the water?
I'll take a stab at that. I mean, if you're investing in a fund, in a REIT, it could be any amount of money. If you're investing as a principal, there's a temptation to go to peripheral markets far away, in Montana or Idaho or Texas. I wouldn't recommend that if you're going to try and invest a small amount of money personally. Um, locally, generally with real estate, it's helpful to be able to visit a property. When you're getting started, you learn a lot more, and you will take better care of your investment. Um, real estate is classified as passive investment, but it does require some physical activity and some paying attention. So smaller investments, I referenced people investing in condos in Vallejo. I mean, that could be $100,000, $120,000, and if you lever it, it could be less for a down payment, as little as 20%. So, it is possible to use smaller dollar amounts even as a principal. But if you're looking to invest $25,000 to $100,000, consider a REIT or consider a fund. If you're looking at a larger investment, and a couple people asked in the chat, well, where do we get this money? Often it comes from selling other liquid investments, selling your RSUs, moving some money out of the stock market, which is massively appreciated, and saying, hey, I want to have some diversification and move it into a different sector. Well, that's your down payment. And then you can use leverage to buy something on your own. It kind of depends upon how much money you are hoping to deploy. If you're up to $100,000, I would say, probably look at putting it in a fund somewhere. And if you are over that, then using debt to acquire a property with that money as a down payment can give you some leverage and a broader exposure to real estate.
Okay. Michael?
Yeah. And I mean, I think Evan mentioned this before, where, he's actually doing this himself, like buying properties. If you're actually buying a property that you're living in and renting out part of that or other units. So that's a way to help offset the costs. On the syndication side, I guess that's maybe moving up the ladder. So it's not quite the entry level. It usually is $50,000 to $100,000 minimum, and that is geared towards accredited investors. So generally you need to have about $1 million in assets for those types of investments, but there are certainly a lot of people in the tech world whose equity has appreciated in their companies, so that they can afford those types of investments. And certainly a lot of people that I work with at Google and other tech companies have moved into real estate and diversified in that way.
Actually, I'm sorry, I realized maybe not everyone in the audience knows what syndication means. Could you just quickly define syndication, Michael?
Sure, and there's probably other ways of thinking of it, but yeah, it's basically a way of pulling a group of investors together on a project, and there's many different ways to structure it, whether it's as tenants in common or a general partnership. But usually there's a sponsor that is leading the investment. Sometimes it's a fund. Think of it like a private equity fund or a venture capital fund where they raise a certain amount of money and deploy it across many investments. And sometimes it's done where each fundraise is for a specific property. So the fund might raise, let's say, $5 or $10 million to buy a very specific building with a specific business plan around it. So it's basically putting together a group of investors and then deploying the capital.
Awesome. Thank you so much. So starting to run out of time. I'll try to blast through maybe two more questions. Um, what do you think are the best real estate opportunities now for investment?
Well, as I said, I am looking on the multifamily side in Dallas, and that's just one market. There isn't a one size fits all. There isn't a best. I mean, Ron and I actually spent a lot of time talking about the distress in office. Personally, I think there's huge opportunities to be made there in the right markets.
With the right operator.
With the right operator, and my skill set is more in residential. That said, I actually looked at a property. I made my business partner and I made an offer on a local property in the Bay Area that was offices and converting that into a few dozen housing units. And nationally, there's a housing crisis, but even locally, there's a lot of interest from local governments in basically being very flexible with developers that want to create housing. So there isn't really one best thing. There's definitely a trade-off between risk and reward. The types of investments that I do are not highly speculative. So I have a lot more conviction that there will be a good return, but it's not going to be the kind of return that you're going to get, possibly if you're at a company that IPOs. But that said, if you're making 10 to 15% a year over 7 to 10 years, you're going to more than double your money. So there are a lot of opportunities. It depends, as I said, asset class and geography. If you're looking to invest with someone else, definitely vet the manager, because it's really your trust in them that's the most important thing.
Okay. You want to chime in?
Yeah. I think for most people, residential is easier to get their brains around than office or manufacturing or retail. And for that reason, it's a great place to start. There's one element of multifamily that I touched on briefly, but we haven't really talked about, and that is, I see a lot of people in tech looking to buy their first property and they need a home. And an alternative to buying a single family home is buying a small multifamily property. 2 to 4 unit buildings are considered for lending and many other purposes as equivalent to a single family home. So you can lever them, you can get favorable insurance. And that is a really great way to get on the housing ladder. If you buy a duplex, buy a 3 or 4 unit building, live in a unit, uh, get mortgage offset from your tenants. Um, and then at some point, if and when you grow out of that property, keep it. Refinance it, pull some money out for a down payment on your next place, and then over 10 years or more, you'll wind up with a series of properties that produce income that well because you've lived in them, and where you've chosen the tenants. So that is a really great place to start, buying a 2 to 4 unit building if you need a place to live, and starting there. You will be a great landlord if you're present.
Okay, awesome. Um, Let me ask this one more question, and it's more of a personal question to both of you. Um, why did you leave tech to go to real estate? Do you have any regrets about that? Or do you think that real estate is much better than tech? What's kind of the personal feelings about like transitioning uh, from one to another?
Yeah, I don't have any regrets, but I also don't feel like it was a trade-off or an either or. So I, well, living in Silicon Valley, follow the tech trends. I use technology a lot. I have found so many uses for AI in real estate. So I'm engaging just my brain and my analytical brain in different ways. I use AI and spreadsheets for analyzing deals. I for this deal that I was evaluating, I actually used AI to read through hundreds of pages of laws to understand, what might actually be built and feasible, and it just accelerates the whole process. In my I also have a portfolio of short-term rental properties, and those are highly operational. You're basically running a hotel, a hospitality business. And I've used technology both off the shelf and some technology that we built in-house to automate a huge amount of the operations of that business. So I still live in tech. It's not an either or, but I just love it's just different types of challenges with real estate. And I would also just say that it's not real estate is not a kind of a get rich quick kind of a scheme. It's really a long-term strategy, and long-term growth strategy. So it's always changing. There are market cycles, and I love being able to learn and adapt.
Okay, your take, Evan?
Yeah, I love real estate. I haven't looked back. I also enjoy the tech sector, and uh, doing multifamily real estate in the San Francisco Bay Area lets me participate in both. Most of my tenants come out of the tech sector. Most of my buyers come out of the tech sector, and sellers of real property. Um, what I love particularly about multifamily in San Francisco is the puzzle. We are in a heavily regulated environment here, more regulated than just about anywhere, both on the construction side and on the rentals side. And what that means is when I look at a new property, it's got the potential to have immense value, uh, locked up in all kinds of tangles. And it's a puzzle. And figuring out how to unlock that value, not in an adversarial way with tenants, but um, eh, collaboratively, um, sometimes through construction, often through things that recent state law has allowed us to do. For example, SB 9 lets us split a lot and build another build another building that's separately alienable, saleable on just about every lot in California. Senator Scott Wiener passed that law, and it's starting to be used, SB 9. ADUs are a relatively new entrant that allows construction without regard to local constraint on just about every property, either within the envelope or outside the envelope in California, but also including San Francisco. And I'm taking advantage of both of those. I'm seeing clients take advantage of them. Um, the the numbers are big enough that it's interesting, and as you scale and as your resources scale, there's really not a limit on how you can continue to do that in a financially meaningful way in real property, and you get rewarded for solving those puzzles. It's really kind of cool. I do like interacting with the tech sector. I do that through my MIT Club board activities, and also just working with, as I said, the tech employees and former tech employees who are owners and tenants in real estate. I think it's fascinating, and I enjoy spending my waking hours figuring out the real estate puzzles.
Okay, wonderful. Thank you so much for your answers. I do see a lot of questions piling up in our chat. Jason, have you um, queued up those questions? And you can ask away. Jason?
Let me unmute. All right. So I'll start from the top, but I'm going to cheat here and grab one that's like Evan's wheelhouse while I'm getting organized here. Evan, Linda asks, I would like to purchase a multifamily unit, but it seems like the interest on the mortgage would cost more than rent for an equivalently sized unit. What can I look at to make it profitable despite higher interest rates, specifically multifamily in San Francisco? Are you familiar with that region, Evan?
Thanks. Yeah, most of what I've done for the last 20 years has been multifamily in San Francisco. And what I would say is, your options are um, decreasing your mortgage cost, and there are a couple ways to do that, or increasing your rent roll. Um, and then a third option would be if you have a need for an amenity in real estate, and you need a place to live, and you can fold that into your purchase also. On the decreasing the cost of owning real estate, um, obviously the larger the down payment you have, the less your mortgage is. Um, in terms of mortgage options, you have conforming loans. Those limits are relatively low for our area. The Fannie Mae loan it's max out for a 4 unit at 2.3 million and change, 3 unit 1.87 million. But there are also banks which absolutely love our MIT Club demographic of borrower, people who are in tech, who have good incomes. Um, Historically, I would have sent someone to First Republic, now Citizens Private, PNC Private, even Wells Fargo, if you park some money there, can give phenomenal rates. And those are ways to drive those interest rates down from, the sevens to the sixes. So you can lower your costs by putting more money in, by getting a banking relationship which has favorable rates. Um, you can increase your income by working with the tenant population. So, our host for this, Ron Koo, several years ago bought an 11-unit building, and he specifically targeted a property where the turnover would track with market increases in rent. So, even though we have rent control, you can get market rent on a turnover. And this particular building had studios and one bedrooms in Pacific Heights in a safe area, and a history of the rent roll turning over every 2 years. So he bet and had his played out that the rent roll would continue to turn over, and his rents received would continue to climb with the market, not the 60% of market that rent control allows. And then the third way is to fold in some amenity value. So if you need a place to live and you want to own a place, um, buy a 3 or 4 unit building and capture some of the value for your home instead of spending between $1,000 and $1,500 a square foot for a house. Maybe you're spending $800 a square foot for your residence, and then you also get the mortgage offset, and that can work.
Great.
Okay.
All right. Oh, I'll just, yeah, I'll just fire off to the next question. But also a reminder, you guys, there's a dinner tonight, informal dinner. You guys can come on out and go deep dive as you want. And this next question is from Leonard, and you kind of hit on it a little bit. So we can, if anyone has anything to add, but why recommend hands-on real estate investments and not exposure to the sector via a REIT?
Sure. Yeah, I think we addressed some of that, like certainly, and I have invested in REITs in the past, and that's a way to get in at with very low dollar amounts. And then I actually did I have invested a significant amount in limited partnerships and other types of syndications. So there it definitely is a I guess I could say lower risk if you're finding a manager with a good track record, a lower risk way to have someone manage your money, but getting the benefits of real estate. And if you are investing in these partnerships, you still are getting the tax benefits of depreciation deductions and that sort of thing.
I would say that one unique benefit of hands-on is the 1031 exchange. So if you own something yourself or in a small enough group where you can be on title, you can roll the gains on any property sale into future properties tax-free, and you cannot do that in a REIT.
Yeah, and I have also in syndicated properties participated in 1031 exchanges. So not just, we're someone else is the sponsor for that.
Yeah, and I also want to chip in that for me personally, I have a rule that I'm open to entertaining real estate myself if it's within 40 miles of where I live.
Mm.
But if it's beyond 40 miles, it's going to be through a REIT, the general partner of a real estate fund, or some other vehicle like a syndication. I'm not going to touch anything that's beyond 40 miles. So it's just a very practical reason for me. Okay, Jason, next one.
All right. It's from Peter. Notwithstanding the recent RTO or return to office movement, isn't there a fundamental shift in long-term demand for office space, particularly in big cities like San Francisco? While there has been some recovery in the market, will there be growth in that sector in the long term? Anyone
Ooh,
want to jump on that?
Actually,
I'd love.
I want to jump on that quickly.
Okay, go ahead, Ron.
I was watching an interview with Francis Greenberger. He's a real estate legend in New York City, and I think he has a $6 billion portfolio. He's got offices everywhere. But he said that he doesn't pay attention to the news headline. He pays attention to the news trend. And what he's seeing overall in office is that corporations are calling their people back to the office. They've experimented with the work from home. They've realized that they can't build a company culture when everyone is work from home, and they can't train young people in the business if they're all at home. So he sees a trend where more and more people are going to come back to the office. That being said, he does acknowledge that there's a tale of two cities right now. There's the Class A plus office building, which in New York are fetching maybe $150, $160 per foot. And then there's everyone else who are like sitting at maybe $50 or $60 a foot. He's never seen that happen before. There used to be only about a 30 or 40% difference between the Class A plus and the Class B and C stuff. So that's what I just wanted to relay. I guess Michael, Evan, do you want to chime in?
Yeah, just very quickly. Office needs change. So much as people say history doesn't repeat, it rhymes. There have been multiple waves of successful officing in San Francisco that occupy different areas. So the old downtown along California Street was very popular. Um, and there was a time when we had Gap's headquarters and Chevron's headquarters, and Levi's, I believe, was initially based here. And then those guys faded, and we got a bunch of tech satellites, and then eventually main tech offices in San Francisco. So there's of course a Google office and a Meta office. Um, a lot of the AI firms that came up are started here. They're in different areas. So the officing center moved from California Street to Mission Street, and now with biotech, it's in Mission Bay, and there's been a huge wave of building and development in that area. Things move around. Seeing what the current wave of business needs is important. Um, we're no longer building out interesting lofty spaces in areas where startup consumer internet companies were, but Mission Bay has giant office towers and they're in high demand. There will continue to be great demand. It's San Francisco is a particular place people like to be and like to work and live, both from a weather, a geography, culture, multiple standpoints, but it won't look exactly the same. So, yeah, there's a big question about what do we do with the old downtown corridor, which is now the old downtown, used to be the new, along Mission Street. And it's an interesting problem. There's buildings which are cheap that can be repurposed. But as Ron said, the Class A over in Mission Bay is still very popular and very expensive.
Michael? Yeah.
All right, great.
Oh.
Oh, okay. Yeah, go on, Jason.
Shall we move on? All right, great. And I think we kind of hit a little bit on the macro trends against the Bay Area, but you guys can jump in if not. Here's another question from Peter about also you guys can optionally jump in on any opinions on 1031 exchange. We'll see where that goes. But I think one question I want to highlight is how should you hold your assets? And I'll read the whole question so everyone can see it. I'll throw in a comment and then I'll let one of you guys pick it up. In an LLC, S Corp, LLP, if the real estate is held in a corporate entity, how does this impact estate planning? For example, do your heirs get a step up in basis of the underlying real estate asset if they inherit the corporate entity rather than real estate directly? I'm just going to add that as a wealth manager, people miss this all the time, but we're in California and we're a community property state. It's really important to understand that and I'm not trying to change spousal behavior, but when one spouse passes, the surviving spouse gets the step up. So that's important for how you hold things, how your money was accumulated while married. Add that to your questions for your attorneys when you're setting up your structure. And that said, do you guys want to comment on structure beyond that?
Yeah, well, I would just say, following on what you said, find a good attorney and a good CPA and do your planning and just be thoughtful about it. A lot of people aren't intentional, and you want to be intentional about things like estate planning.
One thing I will say is if you do buy real property in an entity, please make sure that your insurance names that entity as an insured. There have been stories recently about a mismatch between the entity that's on title and the entity that's insured, and insurance is a challenge right now. You don't want to give them any reason to deny a claim.
Okay, nice.
All right, I'm gonna skip ahead. I'll sort of defer the sort of real estate versus stock questions for another panel. If there's time, we can get back to those. But Karen asks, and again, this is about networking. How do we find out what people are doing, right? Have any of you joined commercial real estate syndication as an LP? If so, what are your thoughts, experience? I'm reviewing some details. I've been pitched, but I'm doing some initial underwriting first.
Yeah, I mean, I've done a lot of investment as an LP. And it's interesting because through those partnerships, I've actually met other LPs that have introduced me to other investments, and just by networking through there. In fact, also by meeting the general partners of these partnerships, I've made some great connections, and also even with their with the service providers. So those have been uh, actually really positive. And as I mentioned before, it's a great way to diversify to other asset classes or geographies where maybe I'm not an expert or I don't have time to participate. So you definitely want to, even though someone else is investing your money, you do want to read through their offering materials as if it were as if you were the sponsor. Really think about it that way. I mean, that's just another great use of AI, is take their spreadsheets, plug it into AI, and have it help you analyze it, and then kind of do your own thinking above that. And then, as I mentioned before, also the managers really um, being comfortable with the people themselves and their track record, their integrity. That's really who you're betting on, because the smart managers are going to put in strategies to mitigate market cycles and adverse events, and they're not going to be 100% right, but um, who the managers are is the biggest impact on the performance of those investments.
I'm gonna be a little counter to general trend and say be physically present. Uh, Real estate is a physical asset. The owners of most of these assets, up to very large dollar amounts, uh, are generally people, and uh, it is not an efficiently priced market when you're buying individual assets. And I I love that, and I love that for my clients because that is how you make money. You buy anything that's a REIT, you buy anything that's in a syndication, it's probably going to be fairly priced. Um, I don't want to buy fairly priced properties. And when you are physically present, I was at a listing yesterday, and someone was poking around saying, "Hey, do you own this building?" I said, "No, it's this person they're selling it." And he had flown down from Seattle to check on three of his rental properties, and he was asking all kinds of questions, and he wanted to sell them. And that's an opportunity for a listing or to purchase it. The guy just he'd had a good run, he had no debt, and he wanted out at what for him was a fair price. So there are tons of those opportunities. They require someone, you or someone you trust, to be physically there. And um, anything you see on the internet, anything that you see in a chat group, has been scrutinized and analyzed and spreadsheeted by a lot of people. And that's great for building your knowledge of what you should be looking for. But once you know what you should be looking for, get out there and find something that nobody else has access to. And that is how you make real money.
So speaking of that, and this will be my last question, unless you want me to dig harder, Ron, because of time. But speaking of digging, Philip asked a couple of questions, but this one in particular: do you think there's a place for buying a property that is not cash flow positive? For example, a condo in Boston or San Francisco, and does not seem like it will be for 3 to 5 years.
I can jump in on that. People do this a lot. If you have the ability to defer gain, um, Chicago, Boston, San Francisco have higher appreciation than other markets. Um, Typically, that's coupled with some ability to use it yourself or for your child to use it while they're in school. So I have a daughter in Atlanta. We didn't end up buying a house there for her to use, but many of her classmates did, and then they rent out the other rooms to other students, and then they sell it or keep it when the student graduates. Um, that happens certainly in Boston around MIT, and people do that here in San Francisco. The two elements of return on real property are current income and appreciation. So what you're describing is much more skewed towards appreciation. I would say if you can add an amenity value to that while it's appreciating, for your child, for you as a second home, um, that helps make it easier to swallow in the current term. But sure, those markets do appreciate. Boston prices right now are rivaling San Francisco in some areas on a price per square foot basis.
Yeah, and to add to what Evan said, or Philip's question was about 3 to 5 years. I think it's better to have a slightly longer horizon to weather cycles. A lot can happen in 3 to 5 years, but if your horizon is 7 to 10 years, you're going to have a lot more flexibility in choosing to sell that asset at a gain.
Yeah, I will say in our specific market here in San Francisco, um, there are a lot of factors which are depressing value right now, which are not going to be permanent. Interest rates, we can argue about whether they go up or down, but there is an insurance crisis right now in California because we have a an insurance commissioner who has, for the longest time, believed that he could win votes by artificially suppressing rates on insurance. That has gotten to the point where pretty much every major carrier has left the state, and the plan of last resort called the FAIR Plan, which is funded by those admitted carriers who are no longer in California, is insolvent after the last LA fires. That's going to get solved. But right now, people are having a really hard time and are paying a lot of money for insurance on properties. That's driving down prices. Interest rates where they are, not necessarily a problem, but when compared to 2% interest rates from 4 years ago, they seem very high. So that has lowered prices and is probably the shock of it is not permanent, whether or not the rates stay where they are. So, yes, things cycle. Yes, 3 to 5 years is on the shorter end of a time horizon. I usually say, in San Francisco, a 5 year time horizon is pretty safe. More than that, of course. But there are also some things that make now a pretty good time in the real estate cycle. So I think you are stacking the odds in your favor if you buy into this environment.
That's
Oh,
great.
I see a
Oh,
comment in the chat. Can I just respond to Yasim
yeah.
about property managers?
And
Has
also make sure you guys like come to dinner and you guys pick up all these questions and they're having a lot of answers in the chat too. But go ahead. Yeah, Evan, take this one and then turn it over to Ron from here.
Yeah, there's just a question on property managers. There are good property managers and terrible property managers, and send me questions. I would be happy to expound on that. Evan at alum.mit.edu.
Yeah, and I just quickly, as Evan said, like be present, visit a property. I think you learn so much more if you're hands-on. The first time you're getting into this, if you're on an income producing property, do the property manager yourself, understand what's involved before you outsource some things.
Yeah, I mean, I do that. I have property managers on multiple buildings, but I keep property management of the 4 unit building where we live in because it keeps me current and I understand the issues.
Okay. Well, uh, time is almost up. I want to first thank my panelists, Evan Mateo and Michael Feldman, for being here today and sharing their experience and their wisdom and knowledge about real estate. I want to thank Jason for running the Fin track at MIT Club in Northern California and being our administrator today. And lastly, I want to thank everyone who attended this event. I hope that it's been useful for you. The recording will be made available later this week so that you can share with friends or you can review any of the answers. And then lastly, again, for the people in the Bay Area, we are having a real estate dinner at 6 p.m. today in Mountain View. So, I hope that as many of you as possible can come. With that, I want to wish everyone hopefully a good afternoon, good evening, or good morning, depending upon where you are in the world.
Great, thanks.